Hi, I'm Ant Joblin and welcome to Markets and Minds, the show where we break down big macro themes into simplified trade ideas. There has really only been one story in the markets over the last week or two, and that's been the ongoing battle between groups of retail investors, members of a well-known Reddit community, and a group of hedge funds. The hedge funds had short positions in gaming retailer GameStop, whose bricks and mortar business model they believed would soon be obsolete as gamers increasingly turn to downloading their games. One of the funds published a research paper explaining the thinking behind these short trades. The members of Reddit training community picked up on this article and took exception to it, partly due to the fond memories they had of shopping in GameStop in their youth, and so began a battle between the two sides. The gamers and retail traders were the same people who had opened commission-free trading accounts during lockdown in the spring of 2020. They made full use of those accounts and social media to buy GameStop shares and options over the stock and encouraged others to do the same. GameStop shares rose by more than 1,570% over the month of January, and the daily volumes traded in the stock reached and far exceeded 100 million shares on several occasions. In the face of such aggressive buying, the hedge funds had little choice but to trade out of their positions for a substantial loss, and one of them required an injection of billions of dollars from investors to stabilize its finances. So what exactly is short selling? Why is it allowed? And can it be a force for good? If you short sell or go short, you are selling something that you don't actually own and are now short of the items in question, whether they are oranges or shares in a listed company. Why would you sell something you don't own? Well, there are two main reasons. The first is to aid liquidity in a marketplace. In the case of oranges, it may be that a merchant is expecting a delivery of fruit in a few days' time and that they are happy to accept an order from a customer even though the oranges are not yet in their possession. The second reason to go short is to try and make money because you believe that the price of the items you sell will fall in value, allowing you to buy back or close your short sale at a profit. So, for example, our orange merchant might be happy to sell short of oranges today because the price of oranges has been bid up or pushed higher by excess demand. This demand will be easily satisfied once the expected delivery of oranges hits the marketplace, at which point the price of oranges should fall. The orange trader can make a profit between the price they sold short of the oranges at and the price they can buy the oranges back for once the delivery hits the market and creates excess supply. Similar principles apply in the trading of stocks and shares and other securities. Supply and demand drive price changes in the financial markets too. When demand outstrips supply, prices rise, and when supply outweighs demand, prices fall. Prices will rise or fall until such time as new buyers and sellers, or supply and demand, can be found. At that point, prices have found a new equilibrium level. To try and smooth out the gaps between supply and demand, market makers, trading firms who make continuous two-way prices in tradable securities, will often go short of stock to a buyer in the expectation that they will quickly be able to find a seller to buy the stock back from. If that happens quickly, then the market maker simply matches one trade against the other, closing their short position and making either a profit or a loss on the trades depending on their respective prices. However, if the market maker can't quickly find a seller to close their short position against, they are forced to stay short of those shares. The market maker will also need to facilitate the settlement of trade and delivery of the shares to the buyer. To do that, the market maker will borrow the stock and will deliver those borrowed shares to settle the trade. Large institutional investors, such as pension funds, banks and insurance companies, are happy to lend out the stocks and shares they own because they receive a fee or rate of interest for doing so from what's known as the securities financing market. The more in demand a stock is, then the higher the borrowing fees are for that stock. It's not only market makers who can trade on the short side, however. Hedge funds, banks and other trading firms can also trade short. They do so if they believe a security is overvalued and that its price will correct and fall, allowing them to buy back the stock at a lower price than they sold it at. To ensure they settle the short trade or make delivery, they too will borrow the stock and deliver those borrowed shares for settlement. That process also adds liquidity into the marketplace, and in theory, going short helps to ensure that supply and demand are more evenly balanced, meaning that prices should not fluctuate wildly without there being new information or news on the security. However, as we have seen with GameStop, if the short sellers find themselves in competition with a large group of buyers, then the price of the stock they are short of can rise dramatically. Sellers of those stocks disappear and the cost of borrowing the stock rises sharply as well, effectively squeezing the short sellers to the point that they have to concede defeat and must try to close their short positions by buying those same shares on the open market, regardless of cost. Short selling and stock borrowing can be thought of as the plumbing of the securities market. When it works normally, it's rarely discussed or thought about, but when it goes wrong, as it has right now, it can create an awful stink. As we can see on our proprietary search tracking tool, Trackstar IQ, there are numerous GameStop-type scenarios peppered across the market, all capturing the imagination of both retail and Wall Street. And without properly understanding what exactly is taking place right now, both retail traders and short sellers are perhaps taking more risk than they should. That's all we have time for this week, but as usual, make sure you do your due diligence before making any investment decisions. To find out more about our Trackstar IQ data, sign up to our free newsletter at investingchannel.com/Trackstar.